permeates, and at the same time it is kind of broadening out in different directions. So I think this result season for that therefore should hold a fair bit of cues for several sectors, be it IT or be it banks from the point of view of margins, or be it even consumption from the point of view of trends. So I think we're looking forward to some interesting outcomes of this result season to be able to judge as to whether earnings can now hold up as we expect or as the market expects.
Okay, Tahir, I wanted your thoughts on what's happening with autos, because the big move this morning is coming into Tata Motors, 5.5% higher. But this is a stock that has frustrated investors in the past. Do you think the worst is over? Is there more upsides, and is there more valuation upside, importantly?
It's difficult to comment on an individual stock, but from whatever I see, I think what we've read about is a decent delivery as far as the month of March is concerned, and it has kind of pepped up expectations. I think it has also been a little bit of a laggard as far as the overall set of auto stocks is concerned, particularly the OEM. So clearly some bit of that catching up coming by. Very difficult to call out overall conditions, especially as far as the overseas business is concerned. But I think there is probably reason to believe that the worst is behind.
All right. Hi, Tahir. Good speaking to you after a while. Tahir, the last time we chatted, you said some of these tech stocks are beginning to look interesting, and so is the case as well with some new age themes. What's your current positioning on the tech stocks? Because that's going to be the big trigger for the next 1 week or so. And the new age themes, have you all got any of them now? Have you all bought any of them?
On your second question first, we've not really added anything. We're just clinging on to whatever we have. Obviously, there's much of it is underperformed, and to that extent, it doesn't really seem right to kind of knock them off either. And probably, you could start seeing somewhat better tidings, especially if the market starts moving to appreciate a little more growth in not immediately, but probably in 3 or 4 quarters from now, when interest rates probably start to move in the other direction. With regard to your first question on IT, I think incrementally, we have 2 sectors, banking as well as financials, which are the mainstay of our market and constitute a very large component of the overall market, as we know. Between the 2 of them right now, and by and large, this matters in terms of portfolio allocation as well as performance outcomes. And I think between the 2 of them, our preference is slightly tilted in favor of technology, simply for the fact that they are unleveraged balance sheets and therefore a little easier to handle. Both of them are now somewhat embroiled as far as global circumstances are concerned, and to that extent, I think there is pressure on both. But between the 2 of them, I think given that IT has significantly underperformed, we're not necessarily thinking of it as a very strong growth recovery out there. It's going to be somewhat stable.
Okay, I think that connection froze. We'll just have Tahir back with us in a couple of seconds. But Tahir was saying that he is not expecting a strong growth recovery in IT services, but it's a space that he's constructive on. 17,631 for now on the Nifty. I'll just have Tahir back with us. Okay, I think Tahir is back with us. Tahir, sorry, just to continue on that point, we got the crux of what you're saying on IT. Gartner put out a note and they put out their forecasts for overall IT spending for 23 and also 24. So it's quite interesting. For 2023, compared to what they were saying, overall IT spending worldwide will grow at. So in January, they said it'll be about 2.5%. They're now saying it should be about 5% plus growth. Overall IT spending. I mean, it's quite counterintuitive in that sense. We'll hear from IT companies, but what's your sense? How would you read this?
That 5% is probably looking similar to what they had forecasted for the previous year, and therefore it's heartening. Although, and it has been up as you said from their earlier guidance as well. So I think as of now, it at least if you go by their forecast, then it's more of the EU. But I would like to think that we need to get into specifics of the Indian IT services companies, and we'll hear a lot more as the quarter goes by and we get the quarterly results, and probably being the beginning of we get some new year guidance as well, so full year guidance as well. So I think it's like I said, I mean, much of the market probably from the point of view of quarterly results is going to be interesting, be it IT from the point of view of guidance, or be it consumption from the point of view of the slowdown, banks from the point of view of their margins, and industrials from the point of view of whether they're able to hold up and deliver to the promise. So I think it's going to be an interesting result season overall. But tech, I think initial estimates are that it's going to be an inline quarter. But as you all know, it rests a lot rests on the guidance which comes along.
Got that. Tahir, how does this RBI pause sort of play? How do you read it as an equity investor? What's your own reading? Is it an acknowledgement that perhaps one needs to worry a little bit about growth as well, because you are worried about the growth slowdown broadening out a little bit, as you explained?
Yeah, so the way I think about it is that RBI is probably it's a relief as of now, and although it is not conclusive, the RBI itself has indicated that this is more of a guarded pause, and they can always come back. I think they're giving themselves time. It is a good move from the point of view of giving themselves time and giving the economy time as well, because you've seen almost 250 odd basis points of interest rate hikes, and let the impact of that permeate down onto the ground. It's already starting to permeate. So
okay, all right. We are having some issues with the video, but I think we got the gist of what you were trying to say. Thanks a lot, Tahir, for joining us and speaking to CNBC TV18. Well, the market is not too bad, not too good. I mean, just sort of ambling along, 30 points higher, but at least holding on to its gains of last week. And the big story really this morning is Tata Motors, 7.5% higher now. I think there are already 1 crore shares, over 1 crore shares being traded on Tata Motors on the upside. Well, let's get in some views now on the market, on certain themes. Venugopal Gare, the managing director at Bernstein, joins us now to talk about that. Venugopal, good morning and thanks a lot for joining in. You now have a buy call in India. You think it looks attractive, at least compared to, or rather a rebound call on India. And I guess, the valuation argument is something that is playing out well for a market like India. But tell us, what is the rationale? Is this a market that will see a big upside from here on? Are we just going to, amble along and perhaps not fall as much as our peers? What's the base case?
Yeah, so yes, I think the word rebound, as you sort of stressed, was the most important word out here. I would probably say that if you were to see the last 18 to 20 months, India has been broadly flatlining, pretty much in a range-bound sort of a market. And in some way on the line, you can call it a bearish sort of a market, even from a global perspective. And you tend to see bear market rallies from time to time, these sort of rebounds and then, sell-offs, which is quite common if you look at the past 18 months as well. Normally, we tend to ignore, quite a few of these bear market rallies if they're pure valuation-led. I guess the reason why we decided to call a rebound this time was largely because it was not just pure valuations. I guess our perspective was more led by the fact that we were also seeing macro bottom out. See, the December quarter was not great. Thereafter, March quarter, some of the data points appear to sort of reflect that we're going to be at least moving into a rebound phase for the macro, which is the second most important point, I guess, which plays in our overall thesis. So what we're essentially saying out here is that the 6 months of underperformance relative to EM was the most important parameter out here. And once we rebound, we essentially go back to where we were in early January, which is that 18,500 for Nifty. To some extent, since EMs in general outside of India are not necessarily in a great situation as well. So what it means is that there'll be a narrowing of that underperformance, which is the most important call out here that we're trying to sort of make. FII flows, of course, do sort of track all these factors, in which we view is perhaps some of the FII flows will start to also improve, given the fact that domestic flows are still generally okay at this point of time. A combination of all that sort of pushes up the market to a different level. So that was a broad call that we were trying to make out here.
Venu, but good morning. But so it's but markets do overshoot, undershoot, etc. Right? So when you say 18,500, you practically will be pretty much close to the all-time highs. So you're calling after that. You're calling for an extended kind of time correction.
Yeah, so I'll tell you the broader thinking out here. See, market, if you look at Nifty, about 1.5 to 2 years back was more than 22 times, 21, 22 times valuations, right? So That is where we started with about 1.5, 2 years back. Now the situation is that we came down to something like 17 point something in terms of forward, Nifty P. So if you go to that 18,500 band, assuming that earnings don't correct meaningfully, especially in the near term in terms of forward-looking outlook for earnings, we're probably somewhere close to 18 plus, 18.5 in terms of valuations. This is more like where we settle it, right? Rather than leading to any change in view on valuation. This is not like the previous 20 to 25x in terms of P. So that is one context. The second thing is, remember that in the macro rebound phase, you tend to sustain a certain level for a while. But the point is, we think that risk will eventually reemerge. Now, these risks potentially could be global side risk, which is still not clear in terms of how volatile the global economy would be. Number two is interest rates. Pause was welcome, but the point is, potentially that risk still remains in terms of how global rates will move. More importantly, monsoons, we still don't know how things are going to shape up, but that information will be available only in June-ish, July-ish. So these risks are more backward-looking second half. Our earlier opinion was that second half the market would rally and bring us back to that 18,500 by the end of the year. We are basically saying that now it's going to happen in second quarter, where it settles in potentially flat lines and start to moderate in the second half.
Hi Venugopal, good morning. How things change, right? Just a few weeks ago when you joined on the show, I was asking you whether or not we could see 16,000, and things have turned around, they've stabilized and looking up from here on as well. So hopefully we move up. But there are a couple of themes that you like, and I believe the real estate basket as well as cement, those themes look good from here on. Explain that to us.
Yeah, see, the interesting thing is when we made this call, we didn't know that RBI is going to do a pause. Even though if you see my report, I mentioned interest rate peaking as one of the thesis, for taking the call. But the perspective is interest rate sensitives do tend to move up, when you see a pause. And of course, when rate cut cycle starts, they tend to rally much ahead of that, which is still some time away. So our perspective on the sectoral calls, especially real estate, cement, was not really married with this rebound call, but this was a part and parcel of what we wanted to buy on the way up. So our thinking primarily is that real estate is still early cycle now, which primarily means our old school thought process that this is like 7-8 years of downturn, post which we've seen 1 year of upturn. Given that we're still off the bottom, affordability has increased, and of course volumes in real estate would have mopped up some bit of inventory over the last 12 to 18 months. You'd start to see a new cycle or a new start cycle commence, which is where construction starts, which is where cement is going to be that early cycle play. When you start to see real estate construction increase or improve in terms of volume. So both are linked to each other in some way. And that's the reason why, this was a part and parcel of the call apart from financials, which we were highlighting as a way to play this rebound.
Okay, so that is on cement, on real estate, and financials are the best way to play this rebound. Got that. I wanted your thoughts on how to approach technology stocks. If you're already an investor and haven't churned out because of the fall that we've seen up until now, is this a good time to do that, or should you keep the faith and expect that the worst perhaps of the fall is behind us in large cap technology?
Yeah, so basically you're bringing this to our thesis, because if you look at the sectoral construct, there is 50% of the chunk of the market we are still not positive on, which is consumption or commodities or utilities. But there's 50% of the market somewhere down the line we are positive on, which is financials and IT. Cement, real estate are too small, in terms of mix. But this is our sort of thinking on which sectors to prefer. See, from an IT point of view, I'll probably argue that one has to take this call that are we moving into a material hard landing globally, or is it a recession? The recession can come in various forms, in terms of how intense, the decline is. In our current thinking is that this is not a GFC, which is what we had highlighted, in a previous interaction as well, that this smells different from GFC. More importantly, given the policymakers are willing to sort of defend, the banking system globally from a collapse, which is the most important differentiating point. And the fact that our viewpoint is that this is not a consumer-led global challenge. It is, very different from what it was in 2008. So in that construct, what you'll probably see is a moderation in IT spends, but we're still not calling for a collapse. So which brings us to the thesis that it does make sense to play a contra in IT, especially services, especially top large, players where you sort of, take some sort of positions in terms of a mild overweight positions, as they call it, to potentially play the surprises out that might come up in the next 6 to 8 months or 12 months. So that's the way we are essentially playing that. It's very hard to give this gung-ho buy everything in IT call. Remember, they're not like at the bottom of the valuations as well, right? So that disconnect still remains.
Okay, just one final question then. We also have a couple of these stocks or a couple of these sectors that have a global exposure, right? Things are very tricky over there. Depending on the market that you have an exposure to, there is a recovery. Europe is still under a bit of pressure. Companies like Tata Motors are doing pretty well globally. What's the sense you're getting? If we do head into a recession in the US, is it better to just keep away from some of these global players? Or is there a sectoral or a geographic bias that you have here?
See, Europe is perennially a problem. I don't think this is an episodic issue. Around what we are seeing right now, I think Europe in general will remain troubled as a geography for a longer period of time. So one can't really take a call today on whether one should be playing Europe. I would probably say the US is the main driver, right? Eventually, in terms of how things will move up, they're coming after to a situation where we've seen a pretty long upturn, for the US economy in general, where this is where we're heading into a smaller, slower growth rate. But the point simply is this, that the delta comes from there. But if you look at two areas within the overall export basket, one is services and the second part is manufactured goods. The reality is, in manufactured goods have also seen some form of inventory corrections over the last 8 months, which is the risk aversion which has happened globally. So we're seeing some of these auto companies as well, which are exporters, having seen pretty weak export numbers all through the last 6 to 8 months. I would argue that, now broadly the sales are more or less matching, the primary sales from India. So which means that retail sales are almost closer. So you may not really see significant downside correction even for the exporters of goods. But the risk still remains for both services and manufactured goods. So it's eventually a call on valuations. I'd probably say that one has to take as to where we're comfortable on. If something is really costly and pricing in a steep recovery in exports, I think that should be ignored. That's the fundamental issue. Second thing is, if you're really exposed to a local geography, let's say like a Europe, and you're present there, producing there, selling there, I would be more worried, rather than you just being an exporter from here and you have other businesses to run. So that's the way I would model it. At this juncture, we are mildly overweight services, which is ID services. We have some positions in terms of, buy ideas within the manufactured goods and autos. For example, don't want to mention the name, but the largest two-wheeler auto sort of exporter from India, we have an overweight call on them, primarily on the expectation that probably exports are bottomed out there. So it's a sort of a muddled but a mixed view out there.
All right. Final question, Venugopal, before we let you go, both India facing risks that could be there. What about the state elections in a run-up to the general election next year? Is that a risk in terms of an outcome out there? Or are we pretty confident that 2024 onwards we'll have the current regime continuing? And also the point you mentioned on monsoons, as of now, what are you factoring in? Will we have an at-par monsoon?
Yeah, so firstly, on the state elections, yes, there always remains a risk. At this juncture, our expectation is that there will be continuity of power at a central level. That's what is the main thinking. Bulk of the state elections are closer to the November-December timeframe. So, we're taking quarter to quarter right now in terms of review. So we'll see what happens at that point of time. But normally what we have seen historically, irrespective of what outcomes come through, the year of election, which is calendar year 2024, the first 6 months of the year, we've normally tended to see markets do well. Something or the other sort of, gives us positivity which emerges in the market. And given that there is still an expectation of continuity of power, I would probably argue that is going to go through. Middle of the year, we have Karnataka, but I think people would still watch how things shape up, in the broader state elections by the end of the year. On monsoons, we are taking a view that the challenges might emerge in July-ish timeframe, because El Nino is still a 50% probability at this point of time. We are taking a call that it will start well. The monsoon should start well. The cropping season should look good. And if challenges emerge, it will be in somewhere around July-ish timeframe, which is what we'll start to see challenges about output or food inflation and things like that, which is what is married to our call, thinking that, hey, once we go to that 18,500, maybe at that point of time, we start to see some moderation coming back in the markets.
All right, Venugopal, we'll leave it at that. Thanks a lot for joining in and, speaking to CNBC-TV18. So that is a rebound call on India, but with some caveats. They prefer financials, they prefer cement and real estate. By the way, the Bank Nifty has now moved into the red, so don't lose sight of that. Maruti Suzuki is one of your big losers in trade, down 1.5%. There was a Goldman Sachs downgrade on Maruti, and they have cut their target price in a big way. Their earlier target price was 11,000. Now they've cut it to 8,800. It's still above where the current market market prices, but they believe that there is persistent weakness in the small car segment, and that's something that could continue to hit Maruti. So down 1.5% over there. Let's dip into a quick break. But on the other side, one of the buzzing stocks has been RHI Magnesita. The company will join in to discuss their fundraising plans. They've raised 900 crores via the QIP route. Later in our quarter tak segment, Rima will analyze expectations from the IT sector in Q4, and Apurva Prasad of HDFC Securities will join in to discuss the sectoral outlook. Stay tuned.
Welcome back. Well, the Bank Nifty has now moved back into the green, and the Nifty, it appears that buy on dips really is playing out because the Nifty is back up towards the high point of the day. So pretty good going out there. But as promised, let's get chatting with the management of RHI Magnesita. They raised close to 900 crores via the QIP route. Now, with the help of these funds, the company plans to modernize some of their operations, capitalize on the opportunities as well in the refractory market here in India, as well as West Asia region. Mr. Pramod Sagar, the Managing Director, as well as the Chief Executive Officer at RHI Magnesita, joins us on the show. Hi, Mr. Sagar. Good morning. Thanks so much for joining in. Good to speak to you, actually, after a while. Now, you had taken a board approval to raise close to around 1,500 crores. You have done a preference issue of around 200 crores to the promoter entity, a QIP of close to around 900 crores. So 1,100 crores done. Will you be looking at raising further money via equity? And also, if you could tell us, what will this money be used for?
Okay. So we have taken an approval from the board and as well as our shareholders for 1,500 crore, but we thought we will be going for 800 to 900 crore, which our paper also shows. And we very fortunately we got almost 150% subscription, but we stick to 900 crores thanks to our investors who have got a faith on our company. 200 will come as preferential from the parent company, which also shows a lot of confidence on the local management, local company. We don't have any plan to further raise it.
Okay, no plan to further raise any more equity. That's good. And what you're going to use this money for? Close to 1,100 crores. Repay debt? If yes, how much?
Roughly 750 will be repaid. We had a bridge loan. So 750 will be paid back as and 300 crore roughly we are going to use for modernization of plants which we acquired from Tata Group. And roughly 100 crore is regular capex.
Okay, so 300 crores you'll be using for modernization of the plant and 300 crores for regular capex. Any inorganic acquisitions that you have planned?
As you know, our strategy is to grow inorganically. We did this in past years, and I would not say no. Yes, if the opportunity will come, it will not be as big as we did in last few months. But yes, we can do it.
Okay, so when you say we can do it, anything that you have earmarked, any kind of number that you're looking at? I mean, how much is the amount that you have set aside for inorganic acquisitions, and would you be looking to do it in this calendar year itself?
You know, nothing is on the table, frankly speaking, but if something comes up, definitely we will do, but it will be in the range of, say, 150 crore to 250 crore, not more bigger.
All right, so that will be small if in case you're going to be doing that as well. Yes. I think Sonia is asking that because you've done such a big dilution. You know, you've done a QIP, doing a pref issue, you're also issued shares to Dalmia. So just wondering why you're so wary of raising any debt. Talking about that, you're going to be reaping 750 crores of a bridge loan. So post that, what is the debt in the books?
It was about 1,300 crore roughly.
Yes.
And we were not very, actually, we are not independent company. We have a global company also, and global company has a lot of debt in their balance sheet. And this debt is also going to sit in their balance sheet, which is not good. So we decided to go this QIP way.
Indeed, it was a very big equity dilution. I get the point. The parent could be a little bit more leverage, but the debt in the listed entity here in India, it'll be around 550 crores post this repayment.
750,
Yeah.
it will be like this only.
550 crores.
Less
All right.
than
I want to ask you about a couple of acquisitions then. On the Dalmia refractory business that you picked up, you were telling us that it's functioning at around 55 to 60%. You're looking to ramp it up, and also you're looking at upping the margins. So give us a couple of numbers. What will the margins be on this asset in FY24? You had said you're going to take it to mid-teens. So could you confirm that? And also on this asset, I think earlier you had drawn out a capex of around 300 crores. But that number was up, right? What is the updated number? Margins and capex.
Yeah, number is same, and it is so early to give any number about the margin and all. It will take probably 4 to 6 months time to really ramp up the things, improve the productivity, reduce the scrap rate and all. But I can say the number will be in double digit at least.
Okay.
Margins.
All right. In double-digit margins is something that you're looking to hold on to, right?
Yes.
Okay, got that. Can you tell us what is the plan on Dalmia's holdings in RHI? I mean, will that be some kind of a overhang? Because I think they have about 14.3%, if I'm not wrong, as per January data.
Absolutely. But I think Mr. Praveen Dalmia is the right person to ask this, whether they will hang on or not.
No, the worry is, Mr. Sagar, the worry is for your shareholders, right? Because such a big holder will have 14%, and I think the lock-in will expire in July or August.
30%. Yeah.
So what happens after that? That's why Sonia asked you that.
We have not discussed with the Dalmia Group as of now, and we understand they can dilute a little bit there, but I'm not sure really. Sorry, I cannot give a right answer.
All right, interesting. Because on their con call, they have said that they want to exit all these non-core businesses. So that's why the refractory business has moved out of the listed entity as well. What about on high tech? The margins out there were much better when you acquired it, I think 27% odd. But what is the sustainable margins for that particular asset that you acquired?
I think 20 to 25% should be the sustainable one.
That's a very wide range, sir. 20-25%. Will it be closer to 20 or 25%?
I should say in between.
In between, okay. 22.
Okay, in between 20 to 25%. Got that. Overall, for your growth, what are you targeting? I mean, you've done about almost a 20% growth in the quarter gone by in Q3. Do you think that is a level that you can sustain in FY24? If not, what is the average growth that you're looking at?
We are in a blackout period, so I cannot give a number, but I would say that the revenue should be double in this financial year from the last year.
Right. Give us further numbers, sir. Now you'll have both these two assets consolidating. High tech, I think, will add close to 250-300 crores, I think, in terms of revenues.
Right.
Dalmia, I think, at optimum levels, I'm guessing it could do around 1,600 crores. So you're currently doing around 2,000. What is it, sir?
Really. Dalmia number should be around 1,200 crores.
1,200 crores for this year, but I think peak levels are around 1,600 crores. So for FY24, 1,200 crores from Dalmia. High tech should be around 250 to 300 crores. And you're currently going at a run rate of around 2,400 crores for the year. So if I add all these three numbers, you should end, FY24 with a number of close to around what? 3,800, 3,900 crores approximately? Closer to 4,000 crores?
4,000 crores.
4,000 crores for FY24. And what kind of margin should we look at for the consolidated entity? That's the existing entity, plus you'll get both those two assets. Dalmia, which is margin a little bit lower, while high tech is better. So consolidated entity, what should margins look like?
14 to 15% should be sustainable margin.
All right. And your market share currently is around what?
It is about 30%. 30%.
Okay. All right.
Yeah.
Okay, we will leave it at that, sir. Thanks a lot for joining in and speaking to CNBC TV18. By the way, the market is picking up some more pace, so just take a look at that. The Nifty is now up almost 50 odd points, about 0.2% higher. And the stocks that are leading from the front, Godrej Properties, definitely very strong commentary from the management and very good sales numbers. So that stock is up 8.5%. Tata Motors, Credit Access, Grameen are the other stocks that are up about 5 to 7% based on both numbers as well as the brokerage positive commentary. So lots of big buzzers in trade. But Q4 earnings season is here and it kickstarts this week with TCS reporting their numbers on 12th, Infosys on 13th. Rima is joining in now with the key expectations. Rima, over to you.
Thanks so much for that. So this is going to be one of the trickiest quarters to lay out expectations, considering that we are in a heightened period of uncertainty. Just look at the broad divergence in expectations. So for instance, for TCS, the range of the constant currency quarter-on-quarter revenue growth ranges from 0.1 to 1.7%. For Infosys, it goes from minus 0.1 to 1.1%. But look at the numbers for HCL Tech. Now, CLSA is expecting a degrowth of 2.9%, but Nomura is expecting a growth of 1.1%. So the expectations are all over the place. But as you can broadly see, the growth this quarter is going to be lower than the prior quarter. Q4 less than Q3. And the key reason for that is the banking crisis in the US regional banks and the European banks may have induced greater caution, impacting the overall tech spends by banking clients, and plus typically March is a seasonally weak quarter. Now, the margin performance amongst large cap is also likely to be more divergent. Now, for TCS, we're anticipating about a 50 basis points margin expansion, but for HCL Tech, margins could come down on a quarter-on-quarter basis. The key is going to be the FY24 guidance, and here we're anticipating Infy to be conservative and guide for a 6 to 8% revenue growth, constant currency revenue growth. But this will be lower than the 16% odd that they clocked in last year. That's FY23. But Infy is Infy, so we're expecting them to be fairly conservative. For HCL Tech, again, it's very hard to get a consensus this time on guidance, but it looks like it could be a mid to high single-digit kind of growth because you've got a minimum of 4 to 6%, and you've got some analysts even going up to about a 10% growth. But both HCL Tech and Infosys are likely to range the upper end of their margin guidance. These are the numbers. For Infosys, 21 to 23% versus this year's margins at 21 to 22%. So the upper end of the margin guidance is likely to be raised. Now let's quickly run you through some of the brief and quick expectations of what we are going to be watching out for. 1, the extent of impact due to the global banking turmoil on deal wins. 2, retail, high-tech, Europe. These were flagged off as some of the weak pockets in the prior quarters. Does the weakness continue this time? Will normalcy return in the second half of FY24? Because what analysts are penciling in is that H1 is going to be weak, but things pick up in the second half of the year. Company-specific TCS is eligible to announce a buyback. It's eligible, but will it do so? Leadership changes have been announced right at the top for TCS and Tech Mahindra, so they will take center stage. And any change in priorities, strategic directions, new appointments as well, right under them. Now, TCS has to announce a new BFSI head. The COO, Chief Operating Officer, will be resigning or retiring next year. And finally, on deal wins, are we seeing a delay in deal ramp-ups? Are sales cycles getting longer? Is there slower revenue conversion? So all these are some factors that we will be watching out for. And finally, considering that the IT stocks have seen a bit of a correction, the valuations now are pretty much what they were compared to their 5-year average. So are they pricing in the uncertainty, the uncertain environment that we're currently living in? Back to you.
Okay, thanks a lot, Rima, for that. Let's pose that question to Apurva Prasad, who's been tracking this sector for ages now. He's the analyst at HDFC Securities. Apurva, it's all up in the air, right? I mean, nobody knows what these companies are going to speak about, considering that growth is slow. Client spendings could perhaps be, under a bit of pressure. But Rima was talking about a 6 to 8% FY24 guidance from Infosys. Is that something that you are expecting as well, or could it get worse than that?
Hi, good morning, Surya. So we do expect it should be in that range. In fact, we believe that the band could probably be a bit wider. So it could be something like a 5 to 8% looking at the current uncertainty. But let's not forget the historical relative conservatism of Infosys. So meaning if you look at historically what's the first guidance been and where they've ended up for the year, typically tends to be higher. So I'm saying 6 to 8 is probably where I believe consensus expectations are. 5 to 8% is, I think, is possible guidance.
All right. Hi, Apurva. Good morning. Thanks so much for joining in. Well, for the sector on the whole, I think now valuations have traded to sub 1 standard deviation. How much of the bad news is already in the price? Would it be constructive from here on?
Yeah, Nigel. So I think we should be more selective from here on. So it is certainly less than 1 standard deviation. So a lot of risks are to an extent priced in. We have slightly moderated our growth estimates. This is more near term. So Q4, Q1. We do expect a sequential pickup beyond that. And at the same time, some of the factors that we're looking at while we're being selective is high line of sight of growth, the probability of outpacing near-term expectations, and the magnitude of growth. So based on that, I believe one needs to be still a lot more selective. At the same time, with valuations that has corrected on a relative basis. I mean, the sector was at 40-50% premium to Nifty, and it's a lot lower. It's more like long-term averages, even if you compare valuations with the Nasdaq, and if you also look historically what it's done over the last 20-year period. Interestingly, Q2, which is the September quarter, it accounts for about 50% of the sector returns. So we're getting there. Q1, which is traditionally been stronger, we do have a lot more macro headwinds. So I think being selective is a stance that we continue to recommend.
For TCS, what is your expectation? Of course, apart from what they talk about the earnings, etc., all eyes will be what the priorities are under the new CEO and the continuity of the current organizational structure. I think that's what the street is looking out for as well. But for shareholders, what should the primary objective be this time around?
Yeah, so from a quarter standpoint, we expect a modest 1% sequential growth, which within the tier 1 they should be the highest. We do expect them to improve their margins by about 50 basis points. So the run rate that they do intend to hit by the year end is I think that's likely to continue. I think sort of leadership transition, more commentary around that, how the org structure changes is likely to play out. I think these will be some of the important factors. Apart from commentary on some of the core verticals, TCS being sort of having a higher exposure in that. So I think commentary around BFSI and some of the core geographies, because we've seen some kind of a divergence even in the commentary of core geographies. So North Am versus Europe, I think these in any case would be important.
All right, you're expecting a degrowth, a sequential degrowth for a couple of companies, right? Large cap IT. Could you tell us which one are those?
Yeah, Nigel. So that's HCL Tech. It's partly a bit of seasonality. So Q3, the PNP business normalizing. So it's HCL Tech and Wipro. So it's slightly below the bottom end of their quarterly guidance. The two companies where we expect constant currency.
Okay. In the last fortnight or so, KPIT Tech was in the eye of the storm, so to speak, right? After that JP Morgan downgrade came in, they spoke about a lot of, derating of the stock as well because perhaps of the scarcity premium going away with Tata Technology IPO being announced. But for a long-term shareholder, what do you do now if you've sort of made money in KPIT Tech, but now these uncertainties have cropped up?
So while we don't cover KPIT, it's not in our coverage, but what we can talk about is the industry tailwinds in the auto R&D space, which is certainly a big growth driver for some of the peer sets, be it a Tata Elxsi or be it an L&T Technology Services. So I think some of the industry tailwinds continue to remain. I think that remains unchanged. But broadly, if you're looking at the ER&D space, on a relative basis to IT services, valuations do seem a lot more.
Okay, pleasure speaking with you, Apurva. Thanks a lot for joining in, and hopefully we'll get to chat with you again post the numbers come through, get a more nuanced analysis on the Q4 numbers. Thanks a lot. Well, for the market, very quiet. The Nifty is still up about 20 odd points, not going anywhere. It's a holiday shortened week, so maybe volumes could be on the lower side. We'll ask those questions to Mitesh Thakkar on the other side of the break, so don't go anywhere. Some technical trades coming through. Welcome back. Well, it's very quiet for the market, but the question we're asking is what happens to some of these stocks that are just soaring away right now? Mitesh Thakkar joins in. Mitesh, before asking you about the market, I want your thoughts on Tata Motors. When the market was opening, you said that yes, there is some more upside, and look at that, it's zooming now 8% higher. Is the risk reward still favorable at this 470 price?
Okay, so Sonia, I think I'll answer this question slightly differently. In the short term, maybe not, because a 485, 480 zone is some kind of a supply pivot. But what is interesting, and I want to add a disclaimer here that I bought some stock today morning. What is interesting here is that the long-term charts now could be possibly shaping up for start of a fresh up move. We saw Tata Motors price peak at about 530 levels, which was way back in November of 21, and it's about a year and five and a half months since then. The stock was basically correcting and consolidating. So I think the positive signs on the long-term chart suggest that once this 480, 485 hurdle is cleared, we should head towards 530, 540 zones, and then beyond that, maybe 600. So very, very positive on the long-term chart. So if you are looking to accumulate, yes. But from a trading point of view, because we've already seen a rally of about 8% today and 480, 85 is some kind of a historical pivot. We made a high around those levels in August, September last year. And therefore, you will see some profit happening over there. This may not be the best entry point if somebody has a less than a week kind of a trading price. But coming to my stock picks, I have two buy calls right now. MGL is something which is broken into fresh highs. So 999 being the stop loss here, buy this one for targets of around 1060. And L&T, which was a recommendation last week as well, continues to go higher, still showing strength. So that's a buy with a stop at 2295 for targets of 2360.
Okay, all right. Thanks a lot for that, Mitesh. Well, let's focus on a couple of stocks that are moving around. And Shobha, that one's popped up in trade. Sonal joins us to give us a quick rewind of what she told us earlier. Sonal?
Well, yes, the real estate pack entirely is doing really well, and Sobha is one of them, high by around 5% because it reported good quarter four operational update. In fact, it was the best ever quarterly sales reported by the company. Bengaluru was the one which saw a flat YOY growth. However, it was Kerala which saw good growth, but NCR this time around saw a dip for the company. In terms of the numbers, sales value in terms of Sobha shares, that was up 26% on a YOY basis. Sales volumes came in at 1.47 million square feet, which is an uptick of 8%, and realizations also up 14% on a YOY basis. As I said, Bengaluru sales this time around flat on a YOY basis at 0.92 million square feet. NCR was lower at 0.18 million square feet, and Kerala, which is the new geography where they are expanding, is at 0.16 million square feet for the company. They launched their first ever project in Hyderabad this time around, and overall launched 3 projects with saleable area 1.06 million square feet, which will come up in sales in the next coming quarter. So yes, overall good set of numbers here.
Okay, good set of numbers coming in there, 5.5% higher. People buying more homes, they're perhaps buying more watches as well. Titan is on our radar. Mangalam will tell us why. Mangalam, over to you.
More watches and more gold, as well as more saris. That's what people are buying in Titan. You know, the strong the fourth quarter update, especially in light of the environment that we're in right now. 23% growth in their jewelry business. That, of course, comes on a low base. Same time last year, because of Omicron-related issues, the jewelry business grew by 1.3%. What really took your breath away this time around was the non-jewelry businesses. 41% jump in their watches business. Also emerging businesses, which include fragrance as well as fashion accessories, growing almost 84%. Taneira saris growing by about 208% too. Overall standalone revenue for the company up 25%. A 59% growth is what we saw in their Carrot Lane business too. March, however, saw some softness on account of a sudden spike that we saw in the gold prices, and to that brokerages have written. Macquarie says that they believe that the demand softening in March will actually reverse now that we're in the first quarter, and also demand at lower price points, which seem to be a bit of a concern, is reversing, though they have an outperform rating with a target of 3250 on the stock. And Goldman Sachs also says that despite tough macros, the company has reported a stellar growth, and that remains an outlier, as a result of which Titan is their only buy that we have in the discretionary consumer sector, and they too have a target price of 3175. So brokerage is happy, resilient growth coming in, stock up 2% plus.
Okay, who are these people?